Hey guys, thank you for watching Legacy Creators. My name is Lindsay Smith, and today's topic is, oh wait, before we get up to that, make sure you subscribe to the channel and make sure you share it with all your friends and hit the like button. Okay, now we can get started. Today's topic is, how do I create my own bank? This topic everybody always asks me about. Everybody wants to create their own bank through life insurance. And today you're going to get an understanding and be very clear by the end what that means. Let's first start off with building your own bank through life insurance is a concept. It is not actually a bank. It is similar to a bank because you're able to build money there and take loans from there. So that's why they say create your own bank. So let's break down what it is. First of all, the only way you can build your own bank through life insurance is through a permanent policy that builds cash value. Those types are whole life and universal life. There are variations of those types. So there are many ways that you'll be able to build that cash asset in the policy. Let's start off with whole life. So in a whole life policy, you are able to buy a policy where you pay for the premium, and over time that cash value builds up, and because the cash value builds up, you're also able to borrow from the cash value. Let me give you an example. If I was to purchase a $250,000 whole life policy when I'm 30 years old, it may cost me about maybe $200, $250 if I was healthy. And by the time I'm 85, if I got a regular whole life, this is a whole life that we pay to age 100, not one of the supercharged whole lives where you can pay it to age 65. There's some you can pay for 10 years, 20 years and be done with paying premiums. Obviously, if you have those policies, the cash value will build faster. That means that the money that you can actually loan from the policy will be available to you faster. So if you're somebody in a hurry to build this cash value, you're going to want to use a policy that the cash value builds faster. Now, when you're purchasing, let's go back to the example. The example of the $250,000, by the time I'm age 85, it may have about, let's say, estimating it might have doubled, maybe about $500,000 in death benefit, maybe about $250,000 to $300,000 in cash value available to you. When we say create your own bank, we're saying that money that the policy built up, and let me just stop you here because I know you're thinking, well, I don't want to wait till I'm 85 for this money to build up. It's building every single year. So I'm saying that by the time you're 85, this is the amount you're going to have. But throughout the time from now until age 85, it will be building up, compounding, okay? So, of course, the latter years will have more money than the beginning years. So depending on the amount of money you're trying to build into this policy will determine how many years you may need to wait to borrow the money. But I want you guys to know, you can't get a $25,000 whole life policy and be expecting this $100,000 next year. Not going to happen. The face amount that you purchase will determine how high that cash value will go because the premiums are obviously going to be higher. So in the whole life policy, the higher your death benefit, the more cash value that policy is going to build. Now, you can structure the policy where you overfund it, which means you dump in additional money on top of the cash value. On top of the premium that you have to pay. The premium is the cost, right? So if I say your $250,000 policy costs you $250 a month, that's your premium monthly. So if you're dumping in money above that, that money is going to go straight into the cash value. But it doesn't go into cash value for free. It does have an interest rate that the insurance company will charge you for putting that money in. That interest rate varies, so it's not like a stuck interest rate, right? So depending on how much it costs for you to put that money in, that's why letting it sit for a longer period of time benefits you more. Now, also, to build your cash value faster, you can get policies where you pay in a shorter period of time. So that's going to kind of like supercharge your cash value. But guess what else it's going to do? It's going to cost you more money. Those premiums are going to be higher. Now, when you have this whole life policy and it builds over time, when we talk about using it as a retirement asset or your bank meaning, okay, I'm going to borrow this money from myself. I'm going to maybe purchase an investment or an asset that's going to grow this money. And then when I make my money back from the investment, I'll put the principal back. The reason why when you create your own bank that you do want to probably pay your policy back is because it starts to charge interest every year that you pull a loan out. You don't have to pay it back. But if you don't, in the long run, the interest will keep building up and it will eat some more of your cash value. So always try to pay your interest back if you can, at least when you're able to. I would put that interest back at least if you're not going to put the principal back. When you put the principal back, it's like a line of credit because you're able to borrow the money, use the money, make money outside, put that principal back. Guess what? Borrow it again. Plus now it's grown to be a little bit higher than it was before. So now we have more of an option to take money out and do something else. That's really the creating your own bank. Now, some people say they want to use it to purchase their car, or some people want to use it to purchase a building. That's fine, but your policy has to have that amount of cash value in it. And for it to have that amount of cash value in it, most likely you need a larger policy. So for people thinking that, you know, their $25,000 or their $50,000 policy is going to get them to purchase houses, it's not going to be sufficient depending on how much that house costs or how much that car costs. So I just want to be realistic with you guys and have you guys have an understanding that the size policy you have does have something to do with how much cash value is going to be available in the policy. It's funny because I had a prospect that I spoke to and their goal was to purchase a home in 2 years, and they were like, I want to build $200,000. So in their head, they thought that if they brought a $200,000 death benefit, that they can borrow that $200,000 death benefit and have it for their house. So they were like, oh, I'm willing to pay, $250 a month. And I said, there's no $250 a month that's going to build you $200,000 in 2 years from this insurance policy. So I do want you guys to understand that the death benefit is not what you're borrowing. You're borrowing the available cash value that's built in the policy. All right. And that also goes into when we're talking about retirement and we're saying we're going to take out a tax-free retirement income, the cash value that's built into the policy, you can take it out on an annual basis or a monthly basis to give yourself an income. But the amount that's in there is based on what size policy you have. Now, because you're taking the income out each year, the policy is also growing as you're taking the money. So it's building more money, allowing you, more money to be able to take out over time. But the policy still needs to be sufficient to get you the income that you would like to have. All right. So that's whole life. And that's how it works with whole life. Let's talk universal life, building your own bank. Building your own bank in a universal life policies are flexible premium, meaning unlike whole life where you have a fixed premium, meaning that when you purchase that policy, if they tell you it's $250 a month till you're 65, it's $250 a month till you're 65. It doesn't change. It is what it is, right? In a universal life policy, you are paying cost of insurance. So there is something called a target premium. You also have like a minimum to keep it in force, and there's a MEC. The minimum to keep it in force is the amount of money that you would have to pay each year for it to last for a certain amount of years, not for a lifetime, okay? Depending on companies, it could be a 15-year period, a 20-year period, a 25-year period, okay? The target premium is the premium that you want to pay. That's the premium that if you pay that, your policy should last till you're 90 years old. So obviously in a universal life policy, you do have the option to overfund this policy. So where I said the MEC limit, that's the amount that you don't want to go past. The MEC limit would be the higher amount above target. So let me give you an example. If I bought a $250,000 policy, universal life, I had a range of premium that I can choose from. My base, let's say my base, so that it doesn't lapse, is $100 a month. Let's say my target premium was $200 and my MEC limit was $500. I can technically pay anything between the $100 and $500, but I know that if I don't pay at least target, my policy may end pretty early and I might outlive it. So I want to pay target or more. Universal life, the wonderful thing is that it's a flexible premium, which means if I'm an entrepreneur and my income changes from year to year, and I want the flexibility of being able to dump in additional money on the years I make more and pay a smaller premium on the years I make less, then universal life might be a good option, as long as I am making sure that I'm paying a sufficient amount to keep that policy in force. So if I'm going to get a universal life policy, then I'm going to want to make sure that I pay target or above. The great thing, of course, is we can structure these universal life policies where the focus is cash value, and so we can get a smaller death benefit and max out how much additional premium that you can put into the policy to make your cash value even higher. So a lot of people like that. But you do have to be mindful in a universal life policy. If you're taking out a lot of cash value, you still have to make sure there's a sufficient amount of cash value that's left in this policy to make it last throughout your whole life. Another thing with universal life, there are surrender charges. And so the surrender charges, typically most companies are somewhere between 10 and 15 years. You will not have access to 100% of your cash value in that surrender charge period, because that money is being held back, okay? The real reason it's being held back is to keep that policy in force during those guaranteed years, right? So now in that time frame, let's say you had $20,000 in cash value in year 5, but because of the surrender charge, you might only have access to maybe, let's say, 10,000 of it, right? Each year, as it gets closer to ending your surrender charge period, you'll have access to more cash value. So again, creating your own bank with the universal life policy is also an option. It does give you an option to probably dump in a little bit more money within the MEC limit on the universal life than in the whole life. Let me explain what MEC is, because you guys are probably trying to figure that out. MEC limit is where the policy has now deemed to be an investment by the insurance company. So if you go above the MEC limit, your policy would then become taxable, and you would have to pay capital gains on your growth. So you don't want that. The whole purpose of life insurance is that you get your growth and don't have to pay capital gains on it. So you don't want to go above that MEC limit and then put yourself in a space where it does become taxable. That's why you want to stay under the MEC limit. So in the whole life and the universal life, there is MEC limits, and you don't want to go above it. So that's why when you are structuring, when your agent structures the policy for you to dump money in, they are micromanaging the fact that they're keeping it under the MEC limit. That's why you can't just go and dump $200K into your policy without really talking to your agent, because it might MEC your policy. Now, if you haven't dumped money into your policy for a few years and you just paid the premium, you will have some excess space to dump in some more money. But again, this is a conversation you want to have with your agent to find out what is your MEC limit and how much you can actually dump in, if this is what you want to do to build that cash value faster so that your bank is larger. Now, again, when we talk about build your bank, how I said, it's a concept. It is not a Chase Bank, right? It's not a bank account like that. It is a bank. It is a life insurance policy that has cash value in it that you can borrow from. You can even withdraw, but that's a taxable event. So you want to take loans from your policy. and you can pay it back. I highly suggest you pay it back. If you're going to be taking out a lot of money, I highly suggest you pay back at least the interest to the policy so that you don't lose more cash value from it taking the money from the interest. What do I mean? Let me break that down. So when you take out a loan, let's just say that loan's interest was 5%. And let's say it's costing you $300 a year. If you don't pay the $300, they then the next year will take the $300 loan from your policy to pay the interest. So that will keep happening. And so that's eating cash value that you would have had. So if you do have the money, then you pay back the interest. So again, I hope you guys have a clearer understanding now of what creating your own bank is and the type of policies that you can use to do so. Please make sure to discuss with your agent what your goals are for the policy and what amount of money you plan on dumping in the policy if you're going to overfund it to build your bank faster, because that way your agent knows from the beginning to structure your policy in a way that will allow you to be able to dump larger amounts of money. You might have to go with a higher death benefit. So again, also click the link in my bio, guys. If anybody is interested in life insurance, you can sign up under my website for you to be able to get an appointment, and I can help you get set up for these type of policies. Again, please hit the like button, subscribe, and share it with all your friends so everybody can be educated on how they can create their own bank through life insurance. See you later.